The opportunity of a lifetime, people. You got to see the glass half full right now. So 3 quick points before we begin the presentation. Number 1, and I think the most important point, angels can fly because they take themselves lightly. That's G.K. Chesterton. I recommend you read him. Don't take yourself so seriously. Be open to other people's opinions. Debate, debate, debate. I love it. Listen. Take it in and breathe. This climate right now is so toxic. You got to relax. I don't care if you're Democrat, Republican, Libertarian. I have friends from all backgrounds. I want that. It expands my mind. It's the proper mindset. Don't be so myopic and say, I'm only going to hang out with Republicans. I'm only going to hang out with Democrats. So number 2, for all you newbies, the old adage, it's not timing the market, but time in the market. Should I say that again? Has been proven true over the years. Research shows that those who stay invested over the long run in a well-diversified portfolio will generally do better than those who try to profit from turning, the points in the market. So don't follow these, as I've talked about, these pump and dump guys, gals, or be like those guys in Los Angeles that split the payments of a Lamborghini Urus between 5 to 8 people, and each person gets a certain number of days a month. I'm dead serious. What a bunch of losers. Folks at dealerships told me this, and it's going on, and it's been reported in the news. Unbelievable. Number 3, a man smiles to hide his pain. A woman cries to hide her mistakes. So, all right, let's talk some real estate. I will give a shout out to Grant Cardone. Fox Business says, there was a report, Grant sees the greatest correction of his lifetime, showing him with a sad face on Fox Business. The article is warning of a significant drop in price. Then when you click on the article, and I've talked about this in the past, in fact, what it is really saying is that this is the best opportunity in history to buy. To quote him, it's real estate correction. It's going to be a great opportunity for individuals, regular everyday people, to actually grab trophy real estate from institutions. This has never happened in the country. He's not telling, people to take loans they cannot qualify for. He's not saying buy anything, and he's not encouraging a repeat of, the irresponsible, behavior of investors back in the 2008 period. He is urging getting spending under control and to accumulate equity to invest, and shopping hard to find those deals. They're going to be coming, and to make sure those deals that you shop for make sense and put into due diligence. So my point is, see how you have to think between the lines with these articles. They have a sad face of this guy, and what he's really saying is this is going to be a great opportunity, and I agree. We talk about the commercial space. Is there 1.5 trillion of commercial real estate debt? In a recent note to clients, investment bank Morgan Stanley said that there is 1.5 trillion of commercial real estate debt that's coming due before the end of 2025. So Morgan Stanley noted that, refinancing that debt won't be easy, particularly as demand for office space remains weak nationwide. Folks, people are also defaulting on multifamily left and right. It's trickled down to residential multifamily nationwide in the multifamily, not just the office space right now. So there's, multiple problems for commercial real estate. And I've done a number of talks on this, other people have, but I've been following it for over a year and a half, and I've been spot on. In a recent Bloomberg survey, about 2/3, 67% of 919 respondents anticipated a coming collapse in the U.S. office market within the next year. So the commercial real estate has been in the doldrums since the onset of the COVID-19 pandemic in March 2020, as you all know if you've been following this, and has continued to experience high vacancy rates and depressed prices as work from home trends continue. There's a hybrid thing going on. A lot of companies are going in 3 days a week. People are pushing back. Interest rates that are now sitting at 22-year highs have added to that sector's woes as well. The higher interest rates are hitting the commercial property sector extremely hard right now, pushing many players to the sidelines. as the expensive financing is viewed as prohibitive. So speculators continue to wait for the market to hit rock bottom right now. So in addition to the downturn in the commercial real estate market, there is kind of another complicating factor on, and I think from all the research and talking to bankers, it's the stress among the regional banks that we've seen in the last year and a half. In the U.S., the regional lenders currently hold nearly 30% of office building debt. That's according to, the one and only Goldman Sachs. I have good things to say about Goldman, of course, and I call them out as well. So many of these smaller banks continue to struggle with high interest rates themselves, as well as increased capital requirements and the heightened risk aversion following the failures of Silicon Valley Bank and the Signature Bank earlier this year. I did talks on that. So this is all to say that the regional banks could get into trouble with their debt exposure to the commercial real estate sector, and investors shouldn't expect the regional lenders to come right into the rescue, folks, in the event that the market melts down. However, while there is likely to be pain ahead in the commercial real estate sector, it's trickling. It's trickling right now if you're reading this stuff. It is unlikely that it will spill over to the overall stock market and cause widespread instability. Yes and no. Yes and no. So the U.S. property sector is large and diverse, and the debt owning is spread out. So with many investors capable of absorbing some of the losses. And you're seeing that, but you're seeing a lot of buildings go for discounts. Florida, I'm following stuff, 80 million going for 55. So what's next? The commercial real estate market is more of a slow moving train wreck than a sudden implosion. It's a slow trickle right now. Higher interest rates take a while to be felt in the real estate sector. They're getting squeezed right now. This is because mortgages and lenders tend to be, multi-year in duration, and rates don't reset at higher levels all at once. Some analysts say it could take until 2027 for the impact of higher interest rates to become, visible across the entire commercial sector. But you're seeing people try to restructure their loans. You're seeing defaults up big time, and some people are losing their buildings right now. So it's just starting. So regardless, the commercial real estate, particularly office space, it's a trouble spot, and investors would be wise to avoid it right now, but there's going to be good buys coming up, and I know people that are buying. So I think we need probably to ask this question: is real estate debt good? Good debt? Hell yes it is, ladies and gentlemen, if it's used creatively. Despite such pitfalls, given the current real estate market, purchasing debt, in my opinion, is an attractive option, but you got to take a look, you got to take a thorough look before you make the leap to know the right price at which to acquire the loan. And the investor, needs a clear strategy and understanding of the asset and the loan documents that can only be attained through, your due diligence, your real estate attorney, and your team. Don't be greedy and just look at it yourself. So when debt is used to grow an investor's real estate portfolio, it is generally considered good debt. This is especially true, when modest, levels of debt are used to finance a property. So this is what I predict when we talk about opportunity. I agree with Grant. Discounted real estate debt, it's going to be the biggest opportunity in over the next 2 to 3 years. The greatest fortunes are made when things are troublesome in the market, folks. I was there after 2008. People buying debt. That's the next best thing to owning property. So, and good buys are coming up and going to come up in multifamily. So during the last Great Recession, which lasted from the late 1980s to the mid 90s, you all remember massive amounts of real estate loans were sold at significant discounts, and buyers of these loans were often making, staggering returns. So naturally, when the current recession hit the real estate and, the banking industries, investors holding debt started gearing up for another bloodbath. However, those debt sales never came. At least it has not happened in the Northeast. although many lenders elected to sell loans, they have been selling, the volume of loans that were expected. So, kind of what's different. One of the primary differences is that the federal regulators did not, they didn't kind of squeeze them, pressure the lenders to sell or foreclose their non-performing or undersecured loans as they did the last time around. So lenders have taken a more, they're taking a patient approach this time, trying to pull it off. So, however, some of the lenders, the time has come to clean up their balance sheets, and they want to raise some capital to, conform to the capital requirements, because those are requirements by banking regulators. So in an investment climate with low returns, real estate investors are expanding significant effort to find loans to buy at a discount. So if an investor is fortunate enough to find a deal on a loan, the investor should understand the debt purchasing process and the customary debt terms. You got to read the fine print. There are two primary vehicles for acquiring loans. A loan auction, where would-be buyers bid on a loan or a pool of loans, and a loan purchase agreement, that's made directly with the seller. So, be careful. And it's just going to be an unbelievable opportunity. And it's trickled down to the residential. I'll kind of end with that, put a bow on it. Goldman and Sachs released updated housing and economic forecast for 2024 to 2027. They're revealing basically bearish predictions on home sales over the next 4 years, along with bullish predictions on home prices. So they say, number one, 3.83 million sales in 2024. Number two, they say about over 4 million, like 4.24 million in 25 and 4.37 in 26. So despite the bearish numbers for existing home sales, Goldman Sachs does not expect U.S. home prices to fall. That is where I disagree. I think the housing market is starting to give some home buyers hope right now. Prices are tumbling in a handful of cities across America right now. I'm looking at the internal data and have brokers giving me info across the country. Looking holistically at this, houses are cheaper than they were last year in 25 of the 100 biggest U.S. real estate markets right now. For example, take the obvious. The price of a typical home in San Francisco is down $81,250 from 22, meaning those who bought at the peak have lost an average of roughly $223 in home equity every day since then. It's even higher. And the declines are most evident in markets that boomed, ladies and gentlemen, during the pandemic. That boomed during the pandemic. I did a talk, and I'll include it in the video link on, Goldman and Sachs for, cities where they expect the worst losses. Number one, like I said, was San Jose. San Jose is one of the most expensive markets in the country, top 3, and it went up 40+%. So it's going to go down 25%. That's not a bust. It's not a bust. We've been greedy, like I said in that video, and lucky, and things went up 40-50%. So here's my point. I'm looking at cities, one of the biggest spec cities in the country right now where speculators have gone in and bought is Las Vegas, Phoenix. You look at Ohio. I'm looking out east, North Carolina. Price drops are happening. I'm looking across the country, withdrawals, expires. I got lists of price drops over the last year. I'm looking at select areas, and I'm just telling you. So it's not just the commercial sector office space that everyone is talking about, because what I'm trying to say is you really got to have the inside track on this stuff, and I do. And, these hedge funds want to get in first, and they say, oh, they're not going to buy. It's going to be down. You need to hold right now while they go in and buy it all. So real estate's an excellent hedge against inflation. It always has been. As Mark Twain said, they're not building any more land. If you're a multifamily buyer, you don't give a shit if it goes down in value. You only care about the cash flow. So if my building that I have paid off goes down in value, I could care less if it's cash flowing $7,000 a month. So there are people that have that mindset, and I have friends that have the mindset they don't want to deal with tenants. Dealing with tenants is the easiest thing ever. So easy for me. I love it. But to put a bow on this, yes, the commercial office sector is bleeding. It's going to be a bloodbath. The lenders are trying to work with people to restructure loans, but you're seeing defaults, you're seeing bankruptcies. It's going to trickle. I do think people should go back to work in this country, like Elon Musk said, because people don't want to work. I think you're more productive when you work. So these companies should push harder. A lot of companies, they're still on hybrid 3 days a week. Get your ass back to the office and work 5 days a week and stay on the weekend and sleep under your desk. I slept under a desk 3 days a week at a .com. Builds character. So I do think we need to go back that, but this culture has changed so much that maybe these companies, work from home, do hybrid. So it's trickling down to residential. It's trickling to multifamily, and there's going to be great buys on single family homes. There's going to be great buys on multifamily, and it's going to be a new age, as Mr. Grant Cardone said. I agree with that. So let me just say this. I got money with Goldman Sachs, and I did a video, and they're wrong on some of their housing, but maybe they have internal data and they want to take care of their institutional investors and not the little guy. I'm trying to look out for the institutional investor, some of my friends, and the little guy as well. So you just got to read between the lines with this stuff. And, there's going to be great opportunities for regular people, and the big ballers are going to be buying too, trust me. And everyone's trying to price everyone out and say, oh, no, don't buy. Stay on the sidelines. Don't buy right now. Bullshit. Get on the field. Get off the bench. Get in the game. It's going to be a great 24, 25, and 26 for investors. Take care.